Saturday morning weekly market recap. Now, I released a video in the middle of the week about the FOMC press conference, what Powell said, a little bit of a reaction type of video. So, a lot of that will be skipped here today, especially when it comes down to bonds and yields and whatnot, just to try to trim down the duration a little bit. Spoiler alert, I'm already kind of sensing I'm not going to be able to, but anyway. So if you wanted that, just go back and check that one. It's a particularly long one, so pick your poison there. As for the rest, particularly volatile week, of course. I didn't stop at Power press conference. We kept on having a lot of movements, so not what you expected at the end of the year, maybe. But I guess for a moment, you could just put aside all your spreadsheets, all your charts, all your liquidity metrics. Let's forget for a minute about the equity markets, the bond markets, the yields, the repo, all of that, right? All of that nonsense. And let's just try to consider one simple fact. Throughout this period of the year, right, there is one thing that you should never, ever forget, and it is a good corollary in order to be happy around year end. If you are an investor, a trader, portfolio manager, or whatnot. And it goes like this, right? Remember, he's making a list and checking it twice, gonna find out who's now too nice. He sees you when you're sleeping, he knows when you're awake, he knows if you have been bad or good, so be good for goodness sake. And I can't really believe that apparently a lot of you actually have forgotten to just comply to these one or two simple principles. It wasn't that easy. Sorry, it wasn't that hard, right? Shame on you, because it just so happened that Powell, or should I say the Grinch, it came in and tried to steal the Christmas and the Christmas rally with it. All right? So, could have just behaved yourself, and now we would be celebrating. We would be. I can't. I can't just do it. I can't. But it was just too funny. Funny week, nonetheless. I mean, the memes were absolutely off the charts. I loved it. And yeah, every time the market kind of seemed to shift to a bearish posture, you're gonna see all the meme coming in, and that's really wonderful. I mean, right? Again, if you don't know how to laugh, you're gonna end up crying in this market. So you better laugh, right? Now let's dive into into the economic calendar, and I'm trying to be serious, right? So what we've seen coming out from Europe, as the Eurozone, as Germany, and UK, flash manufacturing PMI and services PMI. Uh, of course, you can see the dichotomy in here. Manufacturing came in a little bit weaker. The services are holding up a bit better, but I mean, at the end of it, the Eurozone is still in huge difficulties, although no one is willing to speak out loud. And even going ahead, you can see that even Canada didn't really have a lot of positive news. Yeah, CPI was lower. Oh, well, not really lower, but at least it didn't move, right? It stayed relatively flat at the end of it, at least for the month of a month read. Yeah, nothing major there. Um, the I guess somewhere in here you got the BOJ. Yeah, there you go. Unchanged rates. So yeah, I mean all the claims we're gonna raise rates. No, no, you don't. No, you can't. Right. So nothing majors there. Nothing majors there. Uh, what else? Even the Brits didn't really move their rates. So I mean, at that point they will have to, but not yet, apparently. What for GDP quarter over quarter in the US, up to 3.1 from 2.8, and again, it's in line with what Powell actually said. They were forecasting to close the year at 3%, and they are forecasting a 2.5% GDP for 2025. We'll see. And then, retail sales, but retail sales in the US at this point, I don't want to repeat myself. They just give out the data in nominal terms without adjusting for inflation. So for me, lose is a lot of, it lose a lot of efficacy as a data point, right? So I'm not really paying attention to it. I stated that many, many times in the past. So the PCE came in relatively flat, just a few basis points here and there. But, if you look at the core, still on a downtrend trajectory. I think, at the end of it, I keep on thinking inflation is going to come down. It might be a bit more stubborn than expected, a bit stickier. It might take a bit longer than what Powell is actually communicating, but yeah, I think it's going to come down. Now, the problem might be, will it stay down around 2% for a sustained period of time? That remains to be seen, but I still think it's going to come down. Now let's dive into the charts now. Start out with currencies, of course. Now, um, you got these pump in the DXY on the back of the FOMC meeting, and conversely, all the others kind of dropped. Now we got a few relief rally attempt from the euro, the pound, um, the Swiss franc, kinda. And we got, let's say, the Japanese yen and the dollar Canadian, which really struggled even to put together a decent bounce. So again, dollar dominance. Once again, the dollar wrecking ball is crashing all the other uh, peers. And it's not like in other markets it's going really better than that. Like you see the Chinese yuan down at the lows. You see the ruble, which is well, the ruble actually broke these lows. It was never able to reclaim them. Although, still hovering around. At least it doesn't see continuation at the current moment in time. We'll see. We'll see where it goes. Indian rupee down. We mentioned, I guess it was 3 weeks, 2 weeks back, that the Central Bank of India actually opened up a massive short position on the dollar in the effort of defending the local currency against, being depreciated against the US dollar. Uh, how is it working out? Not cool, right? Okay. Brazilian real. Well, Brazil, it's in the brink of a currency crisis right now. If you, I don't know if you've noticed, but it's in the news. I guess, mainly because they bet on these global economic recovery and especially on China recovery, and it's not playing out the way they were anticipating. I guess on top of that, they were a bit fiscally irresponsible, so the market is punishing them. I mean, it's not like you can be as fiscally irresponsible as the US and not paying the consequences. There are advantages that only the US have when it comes down to fiscal responsibility. So, the DXY, it's just shooting higher. I'm bringing up this chart. Uh, it's a monthly chart, of course. So I failed to retrieve the screenshot that I got of these. I just wanted to make a comparison, right? Because I came up with this chart and it was mid-May 2023. So basically that the squiggly line actually starts there because that's where I postulated this one. It was a time where everyone was talking about, the DXY peaked out, topped out. It's gonna get back down sub 90, and I was like, look, the fundamentals are not suggesting it, and it's more likely that you're gonna see the DXY actually keep on going higher. Now, it is a monthly chart, and currencies tend to move very slowly overall, right? But expect this chart to keep on grinding to the upside. And therefore, I was expecting a little bit of a consolidation, reaccumulation, and another try to the upside. Now, looking back at it now, do I still think it's going to get back up to 130? What? No. Honestly, I mean, technically it should, or it got the potential, but given the situation in the rest of the world now, I think you should see major policymakers interventions in the FX markets, even if it starts to crack above 115 or 100 and maybe 110. I think at that point you will see central bankers starting to cry wolf and begging the Fed to do something. And at a point, I guess, as I said in the midweek update video, the Fed's gonna do it because it's not in the best interest of the US to completely wipe out uh, its own trading partners. Because if you don't have trading partners, what the hell are you gonna do? Yeah, you're gonna be the last man standing, but you know, since the economy is globalized, you need trading partners to grow in this environment. And look, you might say globalization is at the end of of this cycle. We are moving toward the opposite process. Yeah, it might be, but as it took decades to get into globalization and to see it unfolding itself, it's probably gonna take at least a decade to see the process being reversed. So in the inner room, even the US at a point will be worried about not having someone to trade with. Okay, and look, if you don't believe that, you don't have to take it at face value as granted just because I'm saying. But you can look at, and again, assuming you trust at least these quote unquote authorities. But if you check what the IMF has to say about it, right, you see that the, the impact of global trades as percentage of GDP, so growth, increased with globalization. And it tends to go in cycles, right? So you got this period right here where global trades were actually going up because we got the industrialization. So what is an industry good for if then you start to produce a lot of stuff and you got a surplus? If you cannot export and sell that surplus to someone else, uh, that you know uh, spare capacity, it's not gonna be of any help. So that's why you have a proliferation of trade, even back in here. And then we got, of course, the wars period, protectionism, mercantilism, and whatnot. And after the World War era ended, we got back to a situation again in blue, kind of similar to these. So globalization started, and whether you like it or not, right? Because there are many people that, even people that I know, that are actually very critic or against the process of globalization. And I get it. I mean, as any other thing in life, you can't really have it both ways, right? Even in the globalization, although you might say overall, on a large scale, if you really zoom out, you need to say that it was a good for the world at large because the proliferation of trades actually helped bringing in peace, right? It's it's what Anthony sometimes says, where traders can't pass, soldiers will. If you can have a good and symbiotic relationship with your partners abroad, And if you see that there is a mutual benefit in being friends, being cooperative, trading between each other, it's going to be an incentive to keep things like that instead of starting wars, jumping at each other throats, you know. So globalization helped. Now, of course, as any other process in the history of mankind, there were losers and winners. So maybe we are biased here in the West to think that globalization was a good thing because we harvested all the good aspects of it. Many other countries, of course, took the other side. But it's like a trade. When you make a trade, when you make a deal, there is always one party in it which is getting the majority of the advantage, and another one which is taking less, if not actually losing in the transaction. So take it as you like, but I still think globalization was a good thing. And the deglobalization process will be disruptive and will bring in a lot of destabilizing factors, which maybe we're not even prepared to face. So, it's going to be a theme, I guess, in the next decade. Maybe not next year, but who knows? From here till the end of the decade and in the 2023rds, it, it could be a factor. We'll see. But no matter what, these are the data for now. And if you check, let's say the US compared to its trading partners, there are just a few in here, but if you check the difference in between the blue line, which is the last decade, compared to the previous decade, so the 2000s up to the 2010s, right? You see that real GDP actually increased with the exception of Japan for some reason. It is also true that Japan has been in a silent depression for 20 years now, so might be that. But overall, there is a good correlation in between these dynamics. So being friends, being cooperative actually paid out. Now, you therefore you see a correlation in what is the real GDP growth of the rest of the world and the US, right? And if you wanna go even deeper and trying to model it out, you can draw, as they do in here, some sort of a regression model. Can be predictive, maybe not. They claim the correlation is particularly strong, but still, it should highlight the fact that where the rest of the world goes, the US, with a good amount or a huge amount or no amount of lag, will follow. So again, this just shows you how these global system all it's all moving together. Whether it's the real economy, whether it's the monetary system, whether it's the global reserve, it is all connected, right? So, you know, when you check something like the US as for the DXY in this case, so the dollar, and you compare it and you try to see if the strength of the dollar actually impacts somehow the strength of the S&P compared to the rest of the world, because MSCI should be, it's an ETF which basically includes a lot of different companies all around the globe, except with the exclusion of the US. So if you see this red line going up, it basically means that the S&P is overperforming all the other markets. And curiously enough, it's overperforming while the DXY goes up. So the dollar is strengthening against other fiat currency. That is no, I mean, it's no mystery. Like, it shouldn't be a surprise, right? Um, but there's always this type of debate, right? First of all, if you read some sort of a textbook, they're gonna tell you, so if the dollar goes up, it's bad for equities or for risk on assets. Well, it depends on the risk on assets we are talking about. because if you took for instance, as in this case, US equities in relative terms, no, it doesn't look so. When you zoom out long, when you zoom out enough, right? So again, it's another one of those things which is particularly counterintuitive to grasp, but if you just start to dig into it, you see that narratives are one thing, data are actually telling you a different story. And this chart is not even up to date. It stops at the end of November, and you see in white the dollar making new lows, right? While if you check now, new lows, now we're going for new highs. So again, whatever you're doing, if we are dealing with higher time frames and medium to long term type of investments or operations or deals, my take on it would be that it's very hard, very, very, very hard to get the global macro right if you get the dollar wrong. So just pay attention to it. It goes beyond my currency, your currency. The dollar is the global reserve currency. And to just disprove another narrative, it is not the global reserve just because the US won World War II. I mean, that is the starting point, right? If you look back into history, when the period of world wars was over, the US was the only game in town when it came down to manufacturing. Europe was completely obliterated, bombed all the way down. So if you wanted to produce something, you needed to go to the US. So they became the powerhouse of the world. And guess what? If you want to make deal with them, if you want to buy what they are selling to you, because even if you check, back then the US was 70% manufacturing, contrary to now, right? If you want to make deals with the US, what did you need? Dollars, because they wanted to be paying in dollars, right? And you know that is the start of how the US dollar took over. And it's also disingenuous to say the US dollar as a currency. When you think about the US dollar, it's not just the currency as in for, the currency that the US government is printing. No, it goes beyond that. The US dollar had these advantages not only in the economic aspect, right? But there are many different advantages, like the rule of law in the US, or the fact that the US actually allowed it to be free. They never, especially after Bretton Woods, right? They never attempted to really control the float of the US dollar relative to other currencies. And at the end of it, since it was widely available and widely accepted, it took on the role of a reserve currency. Also, because, when you got that transition by which the US started to outsource all the manufacturing and they started to be a nation which imported a lot of stuff, if you want to make a deal with the US and you want to export in the US, what are they going to pay you with? Well, they got dollars. Give you dollars, you then take those dollars and you can do two things: exchange them for your own local currency or recycle them back into the US Treasury market. And since it is widely accepted and available, if you are gonna fund yourself for some business or international business, how do you think would be easier to be funded? In what denomination? The US dollar, right? So if you issue debt, which is dollar denominated, you are creating future demand for dollars, because when the debt comes due, you need dollars to repay it. So you're going to need to acquire them, whether by global trades or by selling out your currency for US dollar and then pay down the debt. So again, this is why no matter what people say, especially after '08, when the monetary system really broke down, you got the DXY going up, and I still think it's gonna keep on going higher up until the point the wrecking ball will become so big that policymakers will have to intervene in order to preserve, to maintain the system intact. Everyone is talking about de-dollarization, the BRICS. Look, it might happen. I'm not saying it won't happen. Sooner or later, everything has an end, right? But the way by which it's going to happen, in my view, it's not by the DXY plunging. It's by the DXY exploding higher. It needs to become so painful for other nations to keep on relying on the US as a global reserve, as the main medium of exchange in global trade. It needs to become so painful that the pain of changing the system will be smaller than the pain of keep on living into that system as it is designed right now. That's the only way human beings actually get to a change. If you see the DXY actually plunging and you start to cheer up because, yeah, wow, we made it. We defeated the dollar. We defeated the system. No, no, you didn't. You just gave the system a few more years, if not decades, of running. Because if the DXY goes down, the system will be perpetuated. All right, there is no incentive in changing it. All right, so if you're a dollar bear or a system bear or whatever you want to see it spike into the upside massively, right? If you accept the fact that there is going to be pain in this transition process, assuming we got one in our uh, lifetime, right? Now, yeah, okay, a bit of a tangent on the US dollar, but again, since I talked about all the other stuff for the week in the midweek update, why not taking a bit of a moment to talk about different stuff? So, moving on, let's check gold. Um, what you see on gold? It broke down Thursday, Friday. Tried to retest these just broken. Would you call it secondary apex? Like the first apex would be here, major breakdown, retest, goes down, deeper retest, rejection, and it creates a secondary apex, which has the same characteristics, right? Consolidation, spike, reversal. Consolidation, spike, reversal. Now retest. So what's going to be? Look, if you see it being rejected here, right? Let's say it's gonna go like this, for instance, just an example. At that point, you start to think, okay, so we got this massive rejection in here already, right? But at that point, could have just been a little bit of a liquidity grab. We picked up fresh liquidity, fresh inventory here, and now we are supposed to go to the upside, right? But then you see a failure at new highs in here, right? And the market is coming back down. So if you see another rejection at a point, uh, it's gonna break out of this range sooner or later, right? So if you want to build up a bearish case for gold, it would be being faded right here. That doesn't mean that could it could it trade a bit higher than that? Let's say could it trade even back up into here before being faded? Probably, yeah, maybe. Depends on the volatility and what we're gonna see. But the more neutral, slightly bullish case for oil is oil, gold, in my view, would be having it, reclaiming this range, maybe retesting it, trying to put a little bit of a consolidation together, and then slowly grind into the upside. If you wanna keep on being bullish on gold. Still, at this current moment in time, if I should look at it like a picture, a photograph, I'd say I'm neutral. I don't. It's hard to be, it's hard to be full on bearish because in order to be full on bearish, I would need to see some sort of a liquidity crisis developing itself because at that point, if you got a liquidity event, gold will be sold off because people will be hoarding again dollars, and they're gonna get rid even of gold because it is the only thing which is liquid. There is always a bid for gold. So if you need liquidity, you're gonna liquidate what you got and what you know is gonna have a bid. So up until the point I see that, I'm not so convinced. I'm not saying I'm not convinced that gold couldn't trade back down, but the way I see it, I've seen people posting charts like this. "Eh, yeah, all right. So it's gonna go down in 1 month. Yeah, right. Yeah, mate. 15% down in 1 month. I mean, yeah, could happen, but I I would need to see a catalyst for it. Right? Let's put it this way. Let's check oil. Hell of a lot of nothing in oil. Yeah, still in this range. You know what? At this point, I'm not even gonna spend time on it. I mean, just let's just check out the break even. But they take down a little bit. Yeah. Although although to the revised to the upside, the forecast is revised to the upside for inflation, even in the US, throughout the same week, or really picked the end of last week, but break evens came back down a little bit. Again, look at them at the same as you would do for oil, still in the range, but they didn't spike, right? Uh, they didn't spike, although yields are curious, because I would expect, if the move to the upside in yields is actually sustained by fundamentals, that for inflation or growth, or I would expect the break evens to actually follow up to confirm that they are forecasting higher inflation. Why are they not? Curious. I mean, curious. It would add to my usual case of lower inflation in the future, but again, it's just 1 week. Don't get lost in the day by day, week by week ebbs and flows. What matters is it's really the trend, right? Anyway, let's look at Bitcoin. Major scare, major scare in Bitcoin land. Um, Again, did we? It's gonna be a bit tough. Did we really break any relevant level yet? Um, I would say no, because if you remember, my sort of invalidation for these grinding to the upside would have been in here, right? Below, well, basically below 90, right? Um, are we there yet? I mean, sure, these two candles right here are not particularly enticing, but we got the same at the end of November, right? Uh, we could also say, I mean, this area right here was liquidity was collected in here, then it was stopped in here with this massive volatility. Third top into the overall area. So if it doesn't get back above 101, 102, I would start to shift from at least from bullish to neutral. But again, I keep on looking at Bitcoin in correlation with the S&P or the equity market in general. I I still think it's very difficult to break the long-term trend on Bitcoin if you don't see equities topping out at the same time. But well, or at least confirming it, right? Could also be Bitcoin being much more volatile, being much more of a risk on asset. It might top a, a bit earlier, just from from a risk adjusted type of assessment, right? Let's say if you see or if you think you're seeing a top being put in, right? What would you get rid of first? Um, Maybe the asset which is exposing you to the greater potential drawdown given the implied volatility. Or could also be maybe the asset which gave me the greatest amount of percentage return because I want to lock him in. Well, him, it. But again, we're going to look at stocks in a minute, but I just call me stupid, but uh, especially after these daily candle right in here, I think it's going to put together a little bit of a bounce attempt, kind of like with gold. And then you see if we go for a lower high, right? So failure at new highs, failure at continuation. You might say, okay, at this point, want to switch from potential trend continuation to consolidation because we do know markets they move from everything starts with as it could be in here, right? Starts with a consolidation, you got expansion, it goes back into consolidation, then you got another expansion, and so could also be that you go for expansion, consolidation, reversal. That could be, but there if you say it, there if you don't, but not yet. All right, not yet. It's not today. Might be next week, might be in January, but not today. People are already starting to call the similarities in between this cycle and the 2017-18 cycle as for in putting the top. I've seen comments about, yeah, we also topped out at the same exact date, December 17th. Mm, I mean, uh, all these historical fractal, but when it comes down to the dates, if it was price action, yeah, I, I'm a massive subscriber to the fractal nature of price action. But as for the dates, I don't know really. So again, I would wait to call it defeated. Let's just wait for a lower high first, and then you got the first maybe signs of a shift in the trend, at least on the daily. Then again, if you zoom out on a weekly time frame, what are we talking about? On a weekly time frame, could could come back down to 70 even and still being bullish, So again, we do not discuss the weekly time frame here because these are weekly market recaps. So, but again, just sometimes shifting from one time frame to the other might be helpful. Uh, Quickly, bonds they kept on being sold, and conversely, yields they kept on going higher. Um, the long end was actually going faster to the upside than the short end. So wait a minute. We got the curve which is still uninverted, and it's going for further uninversion, while the long end, as for the yields, it's going up faster than the short end. That would that would call me wrong on the bear steepener. No, wait, what was that? I just mixed up the terms, maybe. Well, my case was that, yeah, it's gonna uninvert, but with yields going down faster at the short end of the curve. And overall, what you might see is bonds, as for the price of the securities, going up. So that what's happening right now, it's basically the opposite of what I was forecasting. So yeah, it would still call me wrong. which again, it could happen. It's not like you're going to be right 100% of the times, right? So be it. Right now, the market is saying I'm wrong, and the market is always the ultimate judge. We gotta listen to what he says. Now, just you know, there's also these though. Look, it might be just me, uh, a little bit of a spoiler alert because I go through these mental process and thoughts experiments uh, 2, 3 times a day, not only for bonds but in general, right? So a little bit of a disclaimer that could be me trying to seek confirmation bias, right? And the simple fact that you acknowledge that sometimes can actually save your life, just for the sake of disclaimer. Because, if you're aware that you are actually trying to basically hang on to every single tiny thing which could still save your thesis, at that point, you're basically making stuff up or either trying to discard all the opposing signals, invalidation signals, and just trying to stick up to what still confirms your thesis. So again, with a little bit of a caveat, but just for the sake of it, I was checking this one. Now, so if you look at the risk premium against, Fed funds and the 10 years, you see that we are now looking at periods where the risk premium is actually positive, right? Fed funds, it's still above the 10-year, but wait. Every time I'm looking at the red lines, so every time Fed funds was above the 10-year yield, that was a top. That probably it's better to go like this. Zooming in a little bit. Yeah, it looks like it. Risk premium is positive. Fed funds in blue was above the 10-year, and we have a peak in yields which came back down. Same, and we are actually in the same situation. It's lasting a bit longer, so that time might be something to be considered. So I guess again, the another point of invalidation would be seeing the 10 years trading back above Fed funds, which I guess it wouldn't take that much time since I guess they are gonna cut in January too another 25 basis points. So if you don't see yields at the medium to long end of the curve actually topping out while Fed funds comes back down, at that point you might say, okay, so these past trend might be invalidated, and it turns out this time is actually different. All right, again, right. So with the caveat, this might just be me trying to see stuff which are only confirming my thesis and discarding all the rest. But at least, even by doing so, you can come up with a little bit of invalidation, which is in this case will be the 10 years trading above Fed funds, the risk premium keep on staying positive, and basically invalidating all the previous patterns, right? Up until the point you got a point of invalidation, I guess you still have some sort of a safety net to prevent you to really losing it and get stuck in a bias. Okay, so we got these survey, uh, which was conducted by Alpine Macro. All right. So basically, they were asking people what do they expect over the next 6 months for yield curve, and the majority of people are actually talking about or leaning toward a bull steepener. Hmm. Bull steepener, they say. All right. So That would make my assumption even a contrarian one. Is it? Maybe, maybe not. Um, I'm keep on thinking because if you got, yeah, I mean, well, it was everything just to say that if the majority of people are on this side of the boat, markets tell us that usually something different is gonna come. So it was just a another tiny bullet point to throw at it, but yeah, just forget it. Talk too many about yields and bonds for this week. All right, we'll see. We'll see. I mean, I'm trying. I'm gonna try to be as honest as I possibly can. Also because I got money in it. So if it turns out I will be forced out of my positions, or even taking a loss, which hopefully it's gonna be as tiny as it can be, I'm gonna me and gonna come here and say, oh, I was wrong. You know what? Can happen, right? Um, let's have a look at the indices. And again, even in here, it's kind of like the same with Bitcoin. Everyone was already starting to say, it's the end. It's the end of the world. It's the top. Powell actually crushed the markets. Uh, then you look at it. You know, despite the small caps, which I mean at this point my stand on the small caps is particularly clear, and even on the industrial right sector, as discussed at the beginning of this video, right? But if you look at the others, especially if you look at the growth stocks, which for the most part they are in the tech sector, right? And even if you look at the S&P, I mean at the end of it, yeah, we got these sharp pullback on news, but yeah, IQ futures, they came in at support and they had a strong bounce. ES futures, kind of the same, although for ES would be the second test. But is it that bad? Like again, you could say, right, draw a line here. If you see a rejection and it goes down, it's fucked. Draw a line in here. If you see a rejection, it's fucked. If on the other side you see, gonna pick one of the two, right? You see the S&P reclaiming the level and keep on rallying off of it. Yeah, no shit, Sherlock. It's bullish. So again, could you might say we are at an inflection point? Could be, could be. I guess could be from especially from a sentiment standpoint, right? Um, everyone was expecting the Santa rally. If that alone is denied, how will the market's going to interpret that? There is also another interesting factor when you look at stocks and the timing of their movements. Now, I'm not divorcing from seasonality. I guess on a larger time frame, seasonality can actually help a lot. I was just about to say though, what usually happens standing to seasonality behaviors. Um, could this be that since we got one of the most important and disruptive elections with an important character of the last I don't know, I'm not American, but could this be of the last 20 years, maybe, since the 2000? So could this be that all the seasonal tendencies with the Trump election and everything about the Trump trade and whatnot, right? Could this be that those seasonal tendencies have been just pulled forward, and therefore, you've seen a huge rally instead of starting out uh, in December, right? We got that massive push right after elections, and now you see that the Santa rally might have been just anticipated, instead of instead that being after the mid-December could have been pulled pulled forward toward the beginning of December. Could this be? Just a thought. I'm not really sure, but it's like, when you got, like, if you remember, I posted that chart, right, about what happens in presidential election years to the stock market, where you got a some sort of a rally, right, from the elections, and then you got a pullback or a consolidation while you get to the inauguration. So, I mean, just think about it. If everyone is looking at the same stuff and everyone is expecting the same stuff to play out exactly the same, could this be that every once in a while there are a few smarty pants here and there which are going to say, you know what, if everyone is expecting this, what if I front run it? And therefore, it becomes a, a dynamic which feeds on itself, because if you see your neighbor which is front running that and it's starting to actually take profits now, you might be incentivized to do the same before those profits you're looking at on the screen are actually starting to evaporate. Could this be? I mean, I guess it's just a legit doubt to put out there, right? But overall, I think if you look at it from a moving average standpoint, right? Uh, the S&P almost got to the 100 days moving average. And last time it did, we got a massive rally. Uh, the Qs actually tested the 55. And again, last time it was around election, to be fair, but it originated a massive rally, right? Um, you do also see that still, if you are a moving averages type of boy, right? You see that overall they are still uh, in this upside posture, because you still got the 21, which is the faster in this case, which is above the 55, which is above the 100, which is above the 200, right? So still, the trend is up, at least as measured by the moving averages. And, you know, I know moving averages are lagging in nature, right? Because the premise would be, yeah, in order to confirm a shift in the trend, you should see the fastest starting to cross below or to the downside relative to, let's say, the intermediary and these lower ones, right? But at that point, if you got that, that means that price action would have needed to be trading substantially below a few structural points. So that's why, structure and price action alone, it's a much better tool. But that doesn't mean that overall, especially on a very large time horizon, moving averages cannot help you. And whether you believe it or not, there are many algos, many automated programs and trading programs which are trading off of these moving averages. So they might start to initiate a good amount of selling if you got one of these moving averages being broken, or conversely, they might start a good amount of buying if you got one of these long-term moving averages being tagged. So whether you like them or not, they do still play a role in these markets, especially when you think about the ebbs and flows. And yeah, of course, the obvious indication of the general overall trend. All right. At the end of it, if you zoom out a little bit, we check the weekly time frame. Is this a top? I I don't think so. Again, don't think so. Well, the S&P, it's behaving the way it behaved over the last 3, 4 months, if not more than that. And I mean, there's really, we could also say the S&P tagged into this little bit of a shelf, right? And so far it bounced off of it. It's gonna take at least another 2 or 3 weeks to see how it unfolds itself. But for now, right? Same for the Qs. They closed down this inefficiency on the weekly time frame, bounced off of this weekly point of release, which was created on the breakout of this shelf. So again, I'm still finding difficulties calling a confirmed top in these markets. And even if you look at it from the standpoint of all those corporations actually engaging in corporate shares buyback, and they announced 6 billions per day, um, if you got a drop like this, isn't it a good opportunity to buy back your stock at a decent discount on top of everything else? So, I mean, could be. That still the I don't want to be called perma bull. I don't like be perma anything, but if there is one thing I do like, it's confirmation. All right, so I'll just leave it at that. I guess the message is it's clear enough, but you can make of it whatever you like. Before uh, quitting, I wanted to look at what Anq did, especially on a Friday, because that was particularly good. Now, these type of behavior, it's the model, and if you don't know him, I would suggest you to go and check him out. This is basically one, well, I only use this one, but it's the main model that Chris Laurie actually uses in order to identify and potentially use all the different characteristics of a price swing when it comes down to price action. And each one of these price signature has specific characteristics, and it tends to manifest itself over and over again on a different level of magnification. Therefore, it is fractal. And if you check at the structure which is created, it gives you good reference points even throughout the day, because we are looking at a 1 minute chart of the NQ futures to potentially make a trade, right? Whether you want to trade with the favor of the trend, or whether you just want to trade and scalp small reactions, which, by the way, with this amount of volatility, what you might deem as small reactions in a price swing like that, we are talking several points. So you can make money with them, right? Um, it was good because I was having these kind of a conversation while all of these was happening. If you zoom out on a larger time frame, what you see is basically that the market, since the US Open, starts to really get back up. I like this area for let's say a terminal type of target for the day. Wasn't really convinced of a full-on reversal, right? But I mean, this area was a tiny little bit of a shelf, right? So I like that. And if you want a bit of 101 on what a shelf is, it's basically it's just a consolidation, right? Then you want to call it a shelf, you want to call it a price pause, whatever. It's just a consolidation before the market keeps on going higher. In this case, keeps on going lower. It's just, nothing moves in a straight line when it comes down to markets. So they move up, they make a pose, and it keeps on going, or it makes a pose and it reverses, right? Everything you already heard. Um, so the point was, when you see something like this happening, right? A market is going up, and you see, like in this case, for instance, you see that we are starting to shift the structure, right? Like in here, it could be. That was the last relevant high before the push down. And now you see the market, which is breaking it in here. All right. And not only that, but it's breaking it while grinding into it. Okay. So we are actually building up what it is a liquidity base. Normally, if you think the trend it's going to be confirmed to the downside, you would see a sharp rejection at these levels. But if you see price starting to grind into it, you might expect that the liquidity which was present is going to be eroded. And so, here's why I say it's fractal, because if you combine these, let's say this is a 5 minutes, right? If you combine it with your 1 minute charts, right, you can start to build up the case for price continuation. Okay. Now, you also get, if you zoom out, especially on the 15, on the 5 minutes yet, uh, these potential terminal point as a target. If you see it as a massive peak up in here, we are now shifting the structure, the flows are shifting to the upside, right? So if you then see on the 1 minute time frame that session starts, a little bit of accumulation around the open, it goes up, it's maintaining itself above the first standard deviation of VWAP in this case, you might say we got a strong trend. So it's very likely we're going to hit that relevant level we identified on a 15 minutes or a 5 minutes chart. So looking at this base starting to be formed, and by the way, if you think, on a 1 minute chart, this is your base. But if you zoom out on a 5 minute chart, this is what? A shelf, a price pulse, like in here, which is why it is fractal, right? So when you see that, actually, when I saw that, I started to think, you know what? We are still far away from this terminal target, hypothetically. I want to take a long in here and see if I can capture a bit of that move. So, started to, I didn't build up a position, but I just bought. So you check the levels. This is the 21,510, let's call it, level, which, if you remember, it's basically right in here. Let's throw a line into it. That should be more or less here, right? So let's say that was the entry, okay? Let's make it in, I don't know, green. All right. Uh, because from a structural standpoint, you got this little bit of a micro, it went off, but it should be these. You should have a little bit of a micro shelf, which has been formed inside the base, which has been forming, which is again just a price pause on the overall larger swing. So you take that position, right? Now it is true. It saw a little bit of a retest. I got a 40 tick stop on this trade. It is true. I suffered a drawdown of more or less 20, 22, 21 ticks, which is, I mean, it's when you got volatility this high, you need to settle for higher risks, right? But at the end of it, price then went for 190 point, 190, no, sorry, 109 points, which, if you are familiar with NQ futures, they move, the price impact on your account. It's basically of $20 per point per contract. So if you got two contracts and they are going 180 points, you do the math. We are talking like for 4,000, a bit more than 4,000, maybe 4,200 bucks. And the risk on the trade is 40 ticks. So 40 ticks should be 200 bucks if you lose it per contract, so 400 bucks. We are risking 400 bucks in order to making more than 4,000. It's a 10-hour trade with all the premise highlighted and derived from the high time frame. Is it a trade which is worth taking? In my book, it's very well worth the risk. All right. And if you zoom that trade out on a 1 minute time frame, you can see while I wasn't particularly concerned of this retest, I still got a little bit of a buffer to protect me. Now it is true when you start to zoom in, and this is a tick chart by the way, and 100 tick is a very faster pace in New York for NQ. But you got a lot of stuff. You got cumulative delta volume divergences building up while the base was building itself up, and even the, again, even on the retest, right? Uh, I'm not overly concerned because I see the market. Yeah, it's coming back testing me out, but at the same point, the volumes on the sell side are slowing down. Are slowing down. So I said, you know what, I'm gonna stick to it. Yeah, right. And let's see what it does. Turn out came back up. Now you might say, okay, but didn't really you didn't really hold the entire trade up to your target. That is true. Um, I closed it around, and again, we should get into the technicals, but around R1, which is just a measure you derived. If you use, let's say, pivots, right? You got your pivot, you got your directional pivot, you got your central pivot, and then from there you extrapolate these levels, which are R to the upside, that should stay for resistance, and S to the downside. So if you go to the upside, you got R1, R2, R3, as for resistance 1, resistance 2, resistance 3. And if you go to the downside, you are gonna have S1, support 1, support 2, support 3. Okay. So I said, you know what, I'm gonna settle for it. I might think it's gonna go higher than that, but 109 points with two contracts, with the risk that usually when you hit these levels, there is a little bit of a reaction. So what if then I'm sitting on a good amount of profits and the market starts to come against me? I'm just giving away profits when I just need a click of a button to lock them in. Funnily enough, and again, it's not going to work like that every single time, but if you check the take profit level, 618, right? And then if you check what happened on this 1 minute chart, that is your 100 and what do we say? 618 more or less. Let's say it's right in here. Let's take round numbers. We got a counter movement of 144 ticks or 36 points. Again, 36 points times $20 per point times two contracts. It's roughly what? 36 times 2, 72 times 10. So we're looking at $700 of a drawdown, right? But would per contract. So you got to multiply it times two, right? So we are looking at more than a 1400 bucks type of a pullback on your P&L. So at that point, the choice is: do I take profit at a reasonable level, or I just roll the dice, even with myself? Because you need to consider that. What are you gonna do if you see you're up more than 4,000, and all of a sudden, in a matter of 2 minutes, 40% of it just evaporates? And then maybe you panic, you close down the position in here, and then you see price keep on going, which is even worse. So again, when you're trading intraday, establish your entries, establish your target, take the trade. If the target is it, take the profits. Also, because if you still have convictions that the market is going to keep on going higher to the terminal level or target, look how many times this market gave you the opportunity to get back in. One, 2, 3, 4, and then finally hit, right? Just we never discussed intraday price action, so why not, right? Just to make the video as long as the other was, right? I was talking about these when it comes down to these terminal targets. So 21,800, which is basically here, as you can read. It went a bit higher than that, 10 points, right? Yeah, okay, it's fine. I mean, with this amount of what was the range for the New York session? So we are talking 646, almost 47 points of a range for the session. Are you okay being off just 10 points in establishing your potential peak or top for the session? I'm not. All right. I was asking because I'm not a profile trader, right? So I'm asking, would be fair to say that this cluster of structure, this shelf as I identified it, would be would it be in line with the value area low of Wednesday? And I got an answer from someone which is actually using the profile, and it was like, yeah, but really the value area for that day would be another type of level. So I said, yeah, okay, maybe I'm just looking in here, but it's not really a match, maybe. All right, so sometimes different traders, different methodologies, different levels. Right? That is good, but still, we were both looking at the same dynamic for price to keep on grinding to the upside, you might say. Okay, now that was the point. And I mean, if you check, this is basically around 5:30 p.m. So we were basically in here. Yeah, 5:30 should be here. We were here, right? Now we came, at least I went out for dinner. I came back to the charts after dinner, and it was around 9:30, right? And there was these. I love these guys for among other things. It's really cool mate to have a conversation with. And he said, we are gonna close above 810, which incidentally is right at the top, right? And I was like, you jinxed it. You jinxed it once again. But he was kind of convinced that we could have gone there. And I was like, look, are we basing for more upside or are we basing for a little bit of a pullback, right? Eventually, price confirmed that type of pullback. We get back not only to 600, something like, but even lower than that. And why, you might say? Well, again, check the time. 9:20 my time, so that would be in here more or less. Is it correct? Yeah, in here basically, around in this area, right? Um, but why the call to get back instead of basing to go up? Well, because you got all the swing which was already unfolded. You got the top in, the apex in. You already got the retest of it, and it's already bleeding down in a very efficient way among other things. So again, if you start to see these patterns repeating themselves over and over again, at a point you kind of develop a little bit of a familiarity with it, right? Oh, I got the thumbnail on the desktop. Well, at this point you already seen it, so it doesn't really account for a lot. So yeah, I mean, again, this is basically why. Um, there's nothing else really to say. The point is all in there. That level, the terminal level, should have been hit and broken through sharply if you want to see a full-on reversal. Otherwise, no. And on top of it, you see the lower time frame swing starting to unfold itself as exhausted. Then it's gone, right? So, a little bit of an intraday type of analysis, a little bit of a trade recap, if you want to call it that, and just to diversify and to keep faith of the usual duration and my initial promise. Now, with that, gonna wish you all a Merry Christmas, assuming you celebrate it, right? I get that maybe not all of them might be Christians or actually giving a crap about Christmas. But no matter, I'm gonna wish you well, and we are probably gonna see nothing major in markets. I mean, I don't even know because I'm not gonna watch them. Futures will be actually closed for the majority of next week, so who cares? I'll see if I can come up with a midweek update, but don't count on it since Christmas Eve would be Tuesday, Eve on Wednesday, the day after Christmas, Thursday in Italy is also a festivity day, so probably next week I'll be completely off. Gonna try to come up with a weekly market recap, although, not expecting a lot for next week. We'll see. I might be totally wrong. Could be, it would be in line with my usual predictions, right? Other than that, again, I hope you're gonna have good holidays and gonna enjoy yourself. Stay with your family, stay with your friends. It's a good time of the year, even if you're not religious, right? It's still the end of the year, so it's a good time to catch up with some folks you might have not seen or been around so much throughout the rest of the year. And it's a good time to have fun with all the people you know and love. All right. So, and with that, before going full on uh, chocolate and hugs and kisses, right? I'm gonna leave you off, and as usual, be nice and be cool. Neil's out.